Good afternoon and welcome to this very important lecture presentation about Dr. Thomas Richards.
No doctor. Oh, no doctor.
No doctor.
Oh.
But
That's your wife.
You are upgraded.
Okay.
Dr. Thomas Richards, and I'm very, very delighted, very pleased I talked to him about 1 hour ago, and it was very important to know him not on the side of the professional side, because that is it's something that you can read in any kind of presentation. But I like the human factor. I'm always obsessed by the human factor, the man, more than figures, numbers. I don't want that. So I think it's a very important person. He's a father of 2 children, daughter and a boy. And I learned so much about him. I knew, for instance, that he learned Italian. He went to Italy. That's my country. Nobody's perfect anyway. And I'm very delighted today just to introduce him, and he's going to talk about something very important for us. Is our future, about what we are going to get, what we are going to find, what we are going to receive from our institution. And this is very important. This is fundamental, because sometimes you have for instance, I saw the pictures of his presentation, but now I want to hear his voice. The voice is what I'm going to receive, more than statistics, more than the numbers and figures and billions. Hey, by the way, the guy, is here, he's dealing with $11 billion. Okay, we're not talking about $300, $400, $11 billion. And he's got a nice team. He's got someone and he has been at University of Missouri for more than 24 years. So if has been there for more than 24 years, he is doing something good. Otherwise, was not going to be there. So I don't want to say more about Dr. Tom Richards, because he's going to introduce himself through his presentation. Thank you very much.
All right, thank you. Okay, well, we'll get started. So we won't take up too much time, but happy to be back, as always, in Kansas City to update you on the retirement plan. I've got some extra stuff I want to go over, just things that we're doing. They don't affect retirees, but I thought it'd be good to kind of talk about that. I've got slides at the end. But let's just hit the first slide, and we'll dig right in, and I'm happy to answer any questions along the way. All right, so this is just kind of looking at the investment office. I always like to show this. I actually go back to FY 2011, and kind of over the time that I've been in the investment office, our assets have doubled from roughly around $5 billion or so. We're up to about $11.5 billion at the end of this fiscal year. Where, why, how is that growing? Well, the endowment for the 4 universities continues to grow every year, which is a good thing. The working capital of the university continues to grow because the university continues to grow, so that's normal, natural. And then the retirement plan, even though it's kind of in a runoff stage now, it's at about roughly $4.5 billion. We'll have the number up there, but we probably have about another $1 billion in growth of the defined benefit plan until it reaches its peak, and that'll be within the next 10 years. It'll peak out around there, and then it'll start to run off. And the last time I looked at data on the runoff, I think from an actuarial perspective, the last person collecting a benefit check is like beyond the year 2100. So it'll be around a long time. So on our next slide, the market, you all have felt it. with maybe extra investments or savings along the way. The bond market has been relatively flat, and equities have been up and they've been down and they've been up and they're up right now. And I suspect at some point they'll be down again. So this is kind of what the markets give us. Again, when we're investing in retirement monies, we're looking at a longer term horizon. We're trying to dampen out some of the volatility and have a smoother ride. So we're not taking as much risk as someone might take if everything was in the equity market and you have a steep decline like that. And just as an aside, and again, this is something you're living with already, but why wouldn't you on a retirement plan fully invest in public equities? Well, because every month we're taking money out of the plan to pay benefit checks. And we don't have a choice when we're taking money out. And so the problem is you'll hit times like this where the market is down and you still have to take money out and pay those checks. And so that downside volatility is problematic when you're in retirement. And we kind of talk to people now thinking about the defined benefit plan. The retirement plan is starting to be in retirement. So you're all retirees in the retirement plan. The retirement plan is actually preparing for its own retirement, and that changes the way we invest the money. And we want to take on less risk and have more stability. So the next slide. So this is just a summary for the fiscal year. So fiscal year ended June 30th. I've got the endowment pool up there as well, but we're just really focused on the retirement plan. And we're looking at a longer term time horizon, so 5, 7, and 10 years. And the actual returns over 5 years annualized, 9.9%. So the policy benchmark is 8.1. So what does that mean, first of all? What do we mean by policy benchmark? Well, that's, in a way, think about that. If we just invested the money in the same asset classes, but had a very simple passive implementation, think index funds, things like that, that would have returned 8.1%. So we delivered 9.9%. That just means that we generated extra value, if you will, by investing the money kind of more in an active way. And then the policy objective for the retirement plan over the past 5 years is 7.1%. Now that number, and it's actually, today it's 7%, but this is over a 5-year period. 7% is what we're assuming from an actuarial perspective for the pension plan in terms of what do we need to earn every year to pay the liabilities and to pay off the unfunded status over the next 10 or so years. The bottom line is the fiscal year was good. Well, this 5-year period really we're talking about. But really 5, 7, 10 years, even over a 10-year period, the actual return, 7.6. Ultimately, the objective for the plan was 7.3. So over the last 10 years, we've exceeded kind of what we were assuming in the investment return perspective. So the next slide, I think we're going to look at just this fiscal year. So this is the 1-year return. It's actually pretty close to the 5-year. 9.3% for the year ended June 30th of 2025. And again, that's relative to the policy objective of 7%. So the 9.3 minus the 7, so we beat the objective by 2.3% in this fiscal year. If you put a dollar amount on that, that's $99 million. So that would show that in this fiscal year, because we were able to earn above what we were expecting, that means for the retirement plan that we put in another $99 million of investment income into the plan above what was sort of actuarially mapped out. And if you think about that too, over the last 5 years, the 9.9% relative to 7.1, so the difference of that is $694 million. So that's $694 million of investment income that goes into the plan above what the actuaries were assuming. So that's good. Next slide.
Could you talk about that last line?
Yeah, so last
Peer
slide.
institutions? Yeah. Peer universe perspective.
Oh, yeah, I'm sorry, yeah. So this is a pure universe of public defined benefit plans. I'm pulling from my memory, but roughly about 500 plans. And so the 1 year numbers, so we were at the 86th percentile. So that means that that's low in the peer universe. So 86% of the universe did better than we did, but over the 5 year period, we're at the 16th percentile, meaning that we outperform most of the peer universe. So why, that's a good question. Why is that? Well, the 9.3% return, of course, is good. It's really good relative to our objective. Other pension plans probably have more of their assets in the stock market, and the stock market had a really strong year this year. And so we intentionally have less in the stock market because we're wanting to take less risk. So when we have a year like this past 12 months, where equities are just kind of going straight up, we would expect to be underperforming other public pension plans because we're taking less risk. So the question really is, it's over a longer time period where you're capturing different markets over multiple years. This is a more balanced, diversified portfolio allocation. Okay, so, and just to kind of follow up on that, so public equities during the year were up 17%. So if we had all of our investments in public equities, we would have had a 17% return instead of our, I think it was 9.3%. But we're diversified across all of these asset classes. So private equity, real estate, private debt, commodities, treasuries, tips, core fixed income. Maybe trivial, but it's kind of interesting. Commodities, 9.4% return. That's partially, I'm trying to think. There's 5% allocated to commodities. Of the 5%, 2% is allocated to gold. This return primarily is coming from the 2% allocated to gold because the other 3% was about flat. So gold, we were talking about gold at lunch. Gold had a really strong year, which, you know, again, is a good thing, and it's a holding of the retirement plan.
What are we in? Are we in, let's see, what I was just looking for. What would you, out of all those assets, where are we mostly?
Well, we're invested in all. So the biggest holding is still public equity, which is a 35% allocation. So that is the biggest. I mean, public equity drives return, right? But it's also very risky. But our target for public equity is about 35%. Other public pension plans could be as much as 50, 60% public equity. And again, in years like this past year, they will outperform, and that's great, but they're also taking on a lot more risk than we are in our plan. But yeah, public equity is 35%. There's an allocation to private equity, I believe that's 13%. Real estate's around 10%. Risk balance is being phased out. You know, treasuries, we got at this point, roughly a 10% allocation to treasuries, 10% to tips. So it's a diversified portfolio across asset classes.
You specifically emphasize risk because it's a closed plan
Yeah,
compared to other public pension plans that are open plans
yeah,
and can take more risk because they have more recovery time.
yeah. And it's, just think cash flow. We try to relate this to people because I think it's kind of intuitive as we're saving for retirement. When you're starting out your career and you're saving for retirement, you're putting money, you're taking money out of your, you know, in a DC plan, so for younger people. You're taking money out of your paycheck, and like every month you're buying into the market, whether the market's up or down. But the thing is, you're putting money into the market. So if you have a long time horizon and you're saving, if the market's down, you really don't care. Actually, you might like it because then you're putting money into the market. When the market's down, you're buying more because the prices are low, so you're happy. And you ride markets going up and down, but the key is your cash is always going in. Now, you all know when you retire, it changes. You start to take cash out. And so it's back to that first graph where markets are up and down, and so it's just like the pension plan. And this has been in the 15 years since I've been here. The cash flows of the pension plan have changed. When I started 15 years ago, we had net cash coming into the plan. So the contributions from the university into the plan were more than the benefit payments going out. Today we're in a position, because the plan is maturing, the benefit checks that we're cutting each month exceed the money coming into the plan. So we are now in a net cash outflow position. So on a net basis, the plan is writing checks net out the door. So that's why that volatility matters, because we don't have a choice. Like if the market's down, we can't say, you know what, we don't want to take any money out, we don't want to sell, because we've got to write all of you pension checks every month. So that's I'm glad you brought that up, because that's a key distinction. And over, certainly over the next 10 years, that's going to keep growing. So the benefit checks are going to continue to grow. As the actives in the plan retire or leave the university, the contributions going in are going to shrink. So we're going to get to the point where the investment income is really funding the plan. So then that kind of circles back again about why do we want a plan that's more balanced and diversified with less risk? Because the investment income is going to be paying the bills, and we want as much as we can to have a fairly steady, reliable stream without lots of ups and downs. So it's just how we manage differently. Next slide. Okay, well, I'll get to this in a minute, but I had some statistics because I was in a meeting. I also help oversee the university's defined contribution plan now. And this is just kind of fascinating to me because I've been along for this whole thing. We currently, this is as of June 30th, so active employees, active university system employees in the defined benefit plan that we all are in, there were 5,371 active members in the defined benefit plan. The new plan that took effect in October of 2019, and that is all 100% DC, that plan currently has 11,950 active members. The hybrid plan, I don't know if any of you all remember that, it came out in 2012. The hybrid plan has 4,116 members. So if you add up the hybrid DB plan and the full DB plan, there are now fewer people in those plans relative to the defined contribution plan that everyone is going into starting in October of 2019. And then just again, this is more information. And as a reminder, the defined contribution now that's in place for new employees, when someone starts at the university, we're taking 8% out of their very first paycheck. So they're auto defaulted into the defined contribution plan, and their very first paycheck, 8% withholding, and the university matches 8%. So every new employee now, if they do nothing, they're saving at a rate of 16% of their salary per month, which is really good. It's a good place to be. People used to talk about saving 10% of your salary. Now it's really 15, and so we're at 16%. The design of that was very intentional in terms of the automatic enrollment and sort of the forced deduction, because we wanted people to save and we wanted people to take advantage of the university match. So I've always found it interesting to follow this data. And again, now 11,950 people in the plan. 85% of all of those people are contributing at 8% or more. And I think a lot of that has to do with the auto default, because from a behavioral standpoint, if you take it out of that first check, people never miss it. If you make people wait a month or 6 months or a year to enroll, well then all of a sudden you're forcing the employees to make a decision of like, I'm gonna have to take a cut in pay to start saving for retirement. I don't wanna do that. If you get it in the first check, it's entirely different. And I don't know how we'd measure this, but I have a suspicion that of the 11,000 or so members in the defined contribution plan, I bet a fair percentage don't even know that they're saving for retirement. And that's okay. Because whenever they go to leave the university, and hopefully they don't, but if they do, hopefully they have a pleasant surprise that they actually have a nice retirement account that's been started for them.
It's the same way as Social Security works. You don't notice it.
Right.
And it's there at the end.
Because they take, yeah, they just take it. So I wanted to give it an update on this. So I'm going to go over some slides that were presented to the Board of Curators. So these are just from the public meeting materials, but just so that you're aware of what's going on. And also just starting out by saying none of this affects retirees at all. And by the way, I didn't mention, I talked about this at lunch. I always say that my wife is a UMKC graduate. She did the 6-year medical program, and she's just finishing up her something like 25th, 26th year of practicing medicine at MU, and she's retiring at the end of August. So she will now be retired and drawing a check. And I will be at some point too. I'm telling you this because we have a vested interest in the plan. So as I go over this, keep this in the context of almost 12,000 members in the defined contribution plan, shrinking numbers in the others. So just as an overall reminder, now I said there were 5,371 active members in the defined benefit plan. Overall, across all of our retirement plans, there are 27,000 members, retired, active, et cetera. So a lot of people that we're dealing with. The liability, so the net present value of the liability to provide every one of us and others with their pension benefits using a 7% discount rate is $5.7 billion. So that's the liability that's recorded by the university of what will be owed to pension beneficiaries over the rest of their lives. Currently, that is underfunded by $1.1 billion. So we have $1.1 billion less in assets than we do the liability. We're funded at 80%. The latest public pension average we have on funded status nationally is 76%. So we are funded above average for a public pension plan, and we have a definite path to get from 80% to 100%. And it's something we focus a lot of time, a lot of effort on, and this is one of the things that I'm going to go over to talk to you about, one of the things that we're doing. So the next slide. You might, or maybe not, would recall, you wouldn't have been targeted for this, but was it last year?
Yep.
Last year we made an offer to terminated vested people in the defined benefit plan to give them the option to be cashed out of the plan for whatever their actuarial value was, as you know, the actuaries came up with the amount. I don't remember the take rate. I want to think it was something in the neighborhood of 10 to 15% of people took that offer and they cashed out. Now, why would the university want to do that? Well, partially we have, in that case, a large number of terminated employees. And again, terminated meaning they're just no longer employees, doesn't mean they were terminated. They left the university. They still had a vested balance in the plan. So one thing is just to reduce the numbers administratively. These are people that have to be tracked for the rest of their life. If they enter into retirement, they'll get a small pension check, but lots of smaller balances of people who have left the university are no longer employed. So part of it just administrative cleanup. Another part though is to the extent we can around the margin. If you recall that $5.7 billion liability, we're trying to do things that we can to reduce that around the edges, to help manage the plan better, because again, we have to pay off the remaining $1 billion. So the next step, so we did the terminated vested. We've actually had requests from employees, from current employees, who are in the defined benefit plan or the hybrid plan, who have wanted the option to go into the defined contribution plan. So, catch up on myself on the slide. So, why would they want to do that? And this might be on the next slide, maybe. Okay, so why would someone want to do that? Why would someone want to convert from the defined benefit or the hybrid plan into the DC plan? Who knows? There could be different circumstances. It could be someone that doesn't plan on staying at the university. Could be someone who might think they can manage their money better. I don't think this really would apply to too many people, but it could be maybe someone that thinks their life expectancy is short and they want to get that cash, so they have it, they can roll it into an IRA and they can give it to beneficiaries or what have you. We really are not going to know for the people that choose this, but we're just pointing out that there will be offers made to current active employees in the defined benefit plan and in the hybrid plan. They will be given a calculation with detail that they can look at that's prepared by the plan's actuaries, and it'll have a cash amount that values their accrued benefit up to a certain point in the defined benefit plan. And if they choose to do that, that money will be rolled over into an IRA, and then going forward, they would be members of the defined contribution plan. Let's see what the next slide would be.
Quick question.
So I kind of covered that. Yeah.
Question, I know that in our days of active service, the period of time for getting vested used to be 5 years.
Yeah.
Still that's the same?
So the defined contribution plan now today, it's 3 years.
Oh, I see.
So if you stay, but if you leave before 3 years, you lose that 8% match,
Right.
which is a big deal. Yeah. So I basically went over this. The main thing, I just wanted to bring it up in case you read something about it or hear something about it. The most important thing to know is that it does not affect retirees. It does not affect the actual retirement plan itself. It's 100% optional. We have no idea how many current employees will want to switch over to the DC plan. But people that qualify for this will get paperwork, get an offer if they're interested in it, and it's their choice. And it helps a little bit, again, around the edges of reducing that liability growth just a little bit. The only other insight that I have, this is just like me guessing, the hybrid plan, I don't know if anyone is in the hybrid plan in here, but again, in 2012, we went to a plan that was half DC and half DB. It was a really good plan. The benefit was pretty good. But at least anecdotally, I found that most people don't understand the benefit, and they actually don't understand what they have. So I don't know if there could be people that are in the hybrid plan that maybe for whatever reason they just like to go all DC. Who knows? We're just going to give people a choice, and it's up to them. If they want to choose to do that, they can. If they don't, they'll stay in this plan. But I will say, and it's easy to say because it's true, the financial health of this plan is very important to the university, to the financial leadership, the CFO, to the board. Everyone is very much focused on how do we continue to manage this in the right way, to manage that liability, to manage how we invest the money, to manage the volatility, and then to keep us on the path that we're on to essentially pay off the unfunded part of that plan. And it'll take time. It's a big plan, and the numbers are big, but I can tell you we're on the path, and we will get that done. And bottom line is, this is absolutely a liability of the institution. It's treated like it's debt, and all benefits will be paid. So that's always a good thing to say. Don't worry about your benefit. Again, I'll be collecting one from my wife in another month or so. And I'll be collecting one for myself in maybe another 7 years. So it'll be there, and it's a good benefit. Happy to answer any questions.
You answered it. You already answered.
Yeah,
it.
okay.
How many, are there 11,950? How many are are retired?
Well, that 11,950, that's the number of active people in the new
Yeah.
DC plan. I don't have the numbers of retirees on that, but, see, I don't have my balances. But again, this is just more maybe interesting, maybe not. On the university's defined contribution platform, Fidelity, we now are up to almost $2.4 billion on that. So if you think about retirement savings, I mentioned the defined benefit plan is about $4.5 billion. The DC platform now is getting up to about $2.4 billion, and it's growing pretty rapidly because if you can imagine, most of the university's payroll with the new employees, they're saving generally 16% of their salary every month, and so those balances are growing. And at some point in the future, there'll be greater balances on that platform than on the defined benefit platform. So it's kind of interesting to follow. And maybe my last piece of trivia, and this is neither good or bad, but of all of the active members in the defined benefit plan, so me being one, good or bad, however you define this, 43% of those are actually saving on the DC side, so they're saving in addition to their defined benefit plan. I'd like to see that number higher, but that tells you the numbers of people that are saving extra beyond just DB that are in the DB plan.
What was that percentage again?
It's 42.9%.
I had a question. At the beginning, you said something about 10 years, and what is happening in 10 years?
I might have talked about a 10-year return.
Yep.
Okay. Can you just repeat what that was?
Sure, if we go back to like the second slide, I think. The next one. So our 10-year return in the retirement plan was 7.6%. Our objective that we needed to hit was 7.3%. So we've been above that over the 10-year period. I don't know if this is what you're referring to. I might have also said that the unfunded liability of the plan will be paid off in roughly 10 years.
Oh, okay, maybe that was it, because, yeah, I was worried about that unfunded 1.1 billion.
Yeah, so the way I describe that and how it works in the pension world, so simplistically, I would think of that as like a mortgage. It's or debt. So that's amortized, and I think it actually is currently amortized through 2040. So it's probably closer to 15 years as I'm doing the math in my head. But the way that's treated just mathematically is it's an amount that's considered debt. It's got an amortization schedule just like your mortgage would, and there's a monthly payment. So that monthly payment is built into the amount of dollars that the university puts into the pension plan. So there's sort of a current cost for current employees and what their benefit accrual would be, and then in addition to that, there's what I'd call the debt payment or the mortgage payment on the unfunded liability that the university also puts in. And that's one of the reasons that the defined benefit plan has cost quite a bit of money. And believe it or not, some of this unfunded status you really can trace back to the financial crisis in 2008, 2009. Most public pensions have never fully recovered from that. And that gets back to what we talked about at the beginning also, is the importance of managing risk, because I'm not sure that in thinking back to the time, I'm not sure necessarily at the beginning of 2008 that people were projecting that there would be a big market hit later that year. I mean, these things by definition are not known when they'll hit, but they hit periodically. And so that's sort of with that in mind, that's sort of another reminder of why we're careful with how we invest the money, because these things happen, and when they happen, we want to protect on the downside. And going back to the point, the retirement plan is in retirement, and we're paying out more money every month than we're taking in. And so that's why we're very careful about managing that.
Maybe someone that wants to look at what that 10, 15-year horizon is for fully funded. Last year, you spent a lot of time on that. That is a recording that's on the UMCRA website,
Okay.
and people can look back at that one, because Tom gave much more detail at that point how that 1.1 billion disappears,
Yeah.
and getting to 100% funding of our pension plan long-term.
Yeah. As long as everything goes according to plan.
Yes, but so far, between last year and this year, no significant changes have happened there.
No, if anything, it's been a good year because we out-earned our
Yeah.
assumed return, so our funded status went up. So we paid more of that unfunded off than we would have otherwise planned. Maybe just the last interesting, again, to me it's interesting, it may not be interesting to people, but increasingly, defined benefit plans are starting to think about more seriously longevity risk. I don't have anything specific on this, but if you think about the things that are going on, and this is just me, I just have a more personal interest in it, but just think about advances in medicine and genetics and artificial intelligence, and imagine where that's going, and imagine, and it would be a wonderful thing that within the next 10 years, let's say there's some cure for a lot of cancers, like, right, that'd be a great thing. I've had cancer myself. If you're managing a retirement plan, that's something you got to think about, because if something like that happens, and I hope it happens, right? It has an impact on things that are using actuarial projections of how long we think people are going to live. And so that's the interesting thing. If you're managing the liability of a pension plan, and you're assuming, I'm making this up, on average, that your average member is going to live to 85, whatever that would be, what if that jumped to 95 because of advances in medicine?
Yeah.
Well, that's 10 years of payments that you haven't been saving for.
So if that jump has already occurred, but you just don't know it, can the defined pension plan handle that jump? If it's already happened, in other words, everybody in this room, our statistical odds of survival are greatly increased to be 95. Will the pension plan be able to handle
Well,
that?
I think, I mean, I think what would happen is, as the trends became, let's say something happened, okay? I think the actuaries that project all these things out and mortality tables and things like that, that would begin to get reflected in the assumptions that actuaries use for all this math. And then that would begin to get adopted by the pension plans with their own plan assumptions. And the result would be pushing up that liability number. So I'm just throwing it out there. It's just more of an interesting thing. And by the way, I mean, think about that also in the context of Social Security, anything like that that's driven actuarially by assumptions on the lifespan of people. So it's something that, you certainly hope it happens, but then it introduces new problems for society of how do you manage that? And maybe on a related note, just because it's interesting, again, in a way, we've done extensive studies, actually, of our population, and looking at mortality, like realized mortality versus assumed mortality. Because again, when you've got a $5 billion liability, you want to make sure your assumptions are good. You will be pleased to know that we've learned this through this process, that college, university faculty have among the longest expected lifespans of any profession.
Except for chemists.
Well, yeah. So it's just interesting from a mortality perspective, as a population, university faculty have a lifespan above normal. And so, and again, with that, we want to make sure that's reflected in the assumptions in the pension plan. That's why we look at stuff like that. But
Does that apply for deans also?
yeah, they're probably more stressed than that.
I think the stress level.
What about staff?
You know, I'd say they probably would say that generally applies, and I think it's partly you have a higher educated, better educated workforce and environment, so I guess people tend to take care of themselves better, et cetera, et cetera. You can imagine different reasons, but it was just kind of interesting to see that as we were looking at the data.
Depends on which dean they work for.
Yeah. Yeah.
Or worked for.
One question, Tom. What about the $37 trillion in national debt? Does the value of the dollar impact any of these calculations, or is that factored in at all, or is that just totally out there?
So it doesn't impact the liability, right? Because the liability is set.
Expressing dollars.
It's just the formula of, you're looking at our wages and you're doing a mathematical formula and you're coming up with a benefit. So it doesn't affect the liability. And as you know, and I hate to even bring it up, but there's no COLA adjustment, so there's no inflation adjustment. It does affect a little bit how we think about investing when we're thinking about inflation. So, like, can you go one more slide? Maybe one more. So as an example, and now we've sort of phased some of this out, but US TIPS, Treasury Inflation Protected Securities. So one of the things that we try to do is think of pieces, tools within the portfolio that respond well to inflation. If inflation is higher than expected. For a lot of reasons, they don't do what you think they do. But I'd actually point to commodities, and then the gold, I mentioned there's an allocation of gold within commodities. Commodities tend to respond pretty well to inflation. So we're thinking about it in terms of what we're investing in, of what kinds of assets would do okay in a higher inflationary environment. Another example would be like within real estate, we have a big allocation of multifamily, so apartment complexes. So housing, very important, it's needed, but again, from an investment perspective, the good thing about that is, let's say you have ownership in making it up, 10,000 apartment units. Well, you've got a constant turnover and repricing of leases, because generally people are on a one-year lease. They're throughout the year, and so you got constant turnover of leases. So if you're in an inflationary environment and rent goes up, you're repricing the income that you're getting as an owner of apartments. So that's just an example of just cash flows.
How do you think about the issue of socially responsible investing as a system?
So one I'd say, actually the state legislature passed a law this past session that it really doesn't change anything, but it makes clear from a fiduciary standpoint that we are only allowed to make investment decisions based on the financial interest of the beneficiaries of whatever pool of assets it may be. So what that state law is saying is that we can't make investment decisions based on a social objective. It's got to be 100% based on a financial objective. But what I would say though is that, and again we mentioned at lunch, we're investing with probably at least 100 different investment firms. I'd say pretty much they're all the investment firms are very mindful of good governance practices, things like that. So I can't imagine we'd be investing with someone, we wouldn't be investing with someone that we weren't comfortable with their investment practices. But in terms of targeting something for a non-economic reason, we've never done that. And now the law is very clear that we can't do that. Yeah.
Tim, is there any provision for the retirees to make suggestions about where you put the money, invest the money?
Not really. I mean, we're always happy to engage and talk. I mean, just like today. We just try to be very mechanical about it and to try to be diversified. And then maybe using real estate as an example. So real estate, again, I mentioned, I think it's 13% of the portfolio. So that's helping to diversify the overall portfolio. Well, then within the real estate portfolio, we're diversifying that. So we're diversifying by property type. So we've got some percentage in multifamily, we've got some percentage in more industrial warehouse, we've got very little in office. And then even within there, then there's diversification by geography. So we've got real estate properties, investments in real estate properties, not just in different sectors, but in different geographies throughout the country. So everything we think of as a level is an opportunity for diversification, because we're not smart enough, we don't think anyone's smart enough to be able to predict the future. And so the best thing that you can do if you operate with humility and recognize you can't predict the future, well, again, you want to be diversified, you want to diversify your bets. Because you don't want to be taking any one big bet on anything in particular. And I'd say whenever you hear someone tell you with certainty what's going to happen in markets, you should turn away, because no one can predict markets, and certainly I don't even attempt to do that.
So did you ever consider in the real estate sector, green buildings and LEED certified buildings? Have you invested in some of that?
Yeah, I'd say, again, it's up to our investment managers who are investing the capital. But here's the example of where that would make sense economically. And it's changing a little bit now, but the tech companies, for example, Google, Apple, Facebook, those kinds of things were very important to them. Some companies were willing to pay more in rent for a completely green building. So if you had an investment thesis that you wanted to invest in green buildings because you felt like if you did it appropriately, there was a consumer out there that would be willing to pay a higher rate of rent for that building because it's more expensive to build, well, that's perfectly sort of rational, and there's a financial decision behind it, that you think you can do that and you can make your required return because you've identified buyers that are willing to invest in that. As opposed to saying that we're only going to invest in green buildings. Because there's a limited market out there of companies that are willing to pay more for that.
But Tom, obviously the political choices on what gets subsidized in tax credits and things like that will be part of that picture.
Yeah, because it'll affect ultimately what kind of return
Yeah.
can you generate from an investment. Yeah. So, anything else?
Tom, I
Yeah.
think you mentioned last year, but if you can go over it again. I'm sure that people like you, the professionals, about societies and groups where you meet periodically, or the journals and all that. And based on your reading of those professional horizons, how many universities in USA, public universities in USA, come close to us in terms of our asset and how well it is managed, ROIs and all that kind of thing?
Well, so one thing I'd say is, with a defined benefit plan, in terms of major universities, you really have Missouri, Michigan, and California. are 3 other university systems that have their own defined benefit plan. I'm not aware of any others, sort of what I would call significant universities that have their own plan. Most public universities, the faculty have always been in a defined contribution plan. That was TIA, certainly in the early years. And then typically you would find the staff of the university in the state's, whatever state they were in, the state's pension plan. So one, we're unique in higher ed with other public universities. Most do not have a defined benefit plan. And so in terms of comparisons, that's why, I feel like we in my office, we live in 2 different worlds. We live in the public pension world, and that's one set of peers. And then we live in the endowment world, and that's a different set of peers. On the endowment side, certainly we look at our performance relative to other university endowments. There's an Akubo survey that comes out once a year that everyone self-reports their returns to. And I'd say in that, our endowment, and can we go to the prior slide, maybe? One more back. So here I've got the endowment pool up. Well, it's a longer conversation, but I would say our endowment is probably in the middle of the pack and there are reasons on asset allocation for that. And at a high level, I'd say part of that's because the university is always focused mainly on the retirement plan, and the endowment plan has tended to follow along. And so simplistically, I'd say our endowment pool has probably taken less risk than other university endowments because there's been a heavier influence of the focus on the defined benefit plan, which has been don't take as much risk, if that makes sense. And so there are differences in asset class allocation. But what I would say is going forward, we will begin to see very different paths for the retirement plan and how it's invested versus the endowment pool. So like if I'm thinking out over the next 5 years, as we talked about, the retirement plan will continue to reduce the risk that it takes. The endowment pool will likely be increasing the risk that it takes. And again, it's sort of getting back into totally different characteristics. The endowment pool has net money coming in, retirement plan net money coming out, and that'll be reflected a lot more in asset allocation going forward.
I have a quick question I'm thinking of this. I remember when I began at the university, we had a choice of 40 different companies that we could invest.
Yeah.
Is that still the same, or has that been taken off?
So that was back in the original 403B, 457. In 2012, when we adopted the hybrid plan, we collapsed everything going forward into Fidelity and TIA.
Yeah.
So if employees had been investing with another provider, they could stay with the other provider, but starting in 2012, every new employee who wanted to save, and at that point it would have been in addition to your defined benefit plan. Starting in 2012, everyone had to start up new accounts with either Fidelity or TIA. And then I want to say, going from my memory, I think in 2019, when we launched the new plan, it's now down to just Fidelity. So if you were in TIA, you could stay in TIA, and that was fine, but new employees coming online were only on the Fidelity platform. And so we are now basically all on the Fidelity platform for defined contribution. And that's overseen.
And I think the university paid, again, matched that.
Well, now it is. Back, certainly before 2012, there was no match on that. It was just something to help people save. Yeah.
We have a question online.
Yeah.
Brenda, did you have a question?
Me?
Yeah. You started to
Well-
talk earlier.
No, I did not, but I will ask one. There's no COLAs projected in these figures, correct?
No. The Board of Curators approved a financial management policy 2 years ago that sort of lays out the path of getting the plan to a fully funded status. And within that plan, it's in the collected rules, it says there will be no cost of living adjustments going forward, and certainly nothing would be considered before the plan would be fully funded. So that's, and again, I think you've got to go back to the late 1990s in terms of when the last time that happened.
Right, right.
Okay, thank you.
Anything else? Plan's in good shape, we're on the right path, your pension checks are guaranteed, all is well. And you know, I'm in the plan too, so I gotta make sure this is all right.
Thank you, Tom.
All right.